let's try and understand the madness in the markets right now. We've got on board with us a first-time TV debutant, Safir Anand, joining in, strategist and investor. Safir, hi, good afternoon. Apologies to keep you waiting. We're in the thick of news flow, had to address all of that. Good to have you on the show, Safir.
Hi, good afternoon, and thank you for having me over. It's a pleasure to interact with all of you and to share my ideas.
You know, we and our viewers are very curious. How did a lawyer, an IP lawyer at that, turn investor, and how long has the journey been?
Well, the journey starts off from my college days when I got interested in stocks, and obviously I didn't have the capital funds to invest. And it was more to do with a quest for knowing what seemed to be maybe the impossible at that point of time. I think it has continued just out of sheer passion, and it's got linked to my intellectual property, because essentially I think US demonstrates this more than anything else, that businesses that are built on intangibles end up having billions of dollars of valuations. So I think it's essentially a journey of understanding business models, promoters, and it all translates eventually into earnings and cash flows.
Okay. It's interesting that you talk about intellectual properties and cash flows, but what about valuations? Because the stocks which you currently like essentially are some of these IP companies, brand owners, but they are also trading at levels which are unheard of. Titan at P of 70, Venky's, I don't even want to calculate the P multiple there. Unilever trading at a historic high, it has never traded at these levels even in the last bull market.
Well, that's true. I think a large part of that answer comes in from assessing whether the moats being created by the companies are going to last, or assessing that the moats are being threatened by what is called as disruptive innovation. In some cases, there is disruptive innovation which is not necessarily emanating from the companies itself. For example, in consumer companies, a lot of disruption is coming in from a transition into a GST model and a migration from the unorganized sector to the organized sector. I mean, just to give you an example, you know how Gillette's entire business was threatened by a Dollar Shave Club, and Dollar Shave Club reached unprecedented valuations before it was acquired by Unilever globally. So and today, they have a sizable part of the market, and Gillette is to some extent struggling with loss of market share. So it's essentially seeing what the potential of these several companies is commensurate to the market size.
Welcome back. You're still watching Closing Trades right here on ET Now, and we are still in conversation with our fundamental guest, Safir Anand. Safir, give us a sense of how you would look at playing the consumption theme in the market right now, because it's the most fancied theme. I would believe that it is part of the common sense investing that you propagate, but valuations seem stretched there for the entire segment. How do you pick and choose, and how do you draw that balance of when to say let's buy and hold, and when to say I've held it for long enough, now let's sell?
Yeah, so I'll start with a caveat that some of the consumption ideas that I hold today are ideas that I have bought, when GST was introduced, and to that extent have benefited from the price movement that is already reflected in the stock prices. Having said that, GST is still migrating, and when I read interviews that are coming from top level consumption companies, whether it is a Nestle or a Britannia, I'm more interested in seeing the size of the market that lies before them. There are two sides of this. One is the general size of the market is growing because of acceptability of more and more people to consumption, which is more like a volume denominative growth. And because these companies are efficient in terms of their annual reports, the volume denominated growth obviously translates into better cash flows and therefore higher margins, because the companies deploy capital at a far better rate than most other companies. And the second side is a little bit of the migration side, where there are value added products being introduced by these companies. And the result of value added products, I mean, Maggie was a clear example recently. The value added products obviously create new market segments and give higher incremental power to earnings. So since GST itself is relatively new, and we still have people who are grappling with compliances and forms and other things, I think the story of migration will continue for a while, until and unless efficiency sets in all respects, and the unorganized sector has sort of lost a certain part of the market share. And then one will have to take a call on whether they would like to own stocks in this sector or move on to other promising plays.
Okay, that's that on consumption. But Safir, interestingly, IT as a theme is, has been the darling of the markets in the last 6 months or so. If you bought IT stocks, and largely just about any of them, barring a few odd exceptions here or there, you're in a happy spot right now. But you believe that it's actually niche mid-cap IT where you find value. What within mid-cap IT interests you?
Yeah, so the large companies have become extremely dependent upon very large order inflows, and large order inflows come from clients that have substantial bargaining power. And when you find that you're on the receiving end of bargaining power, you don't want to lose a prestigious client, and therefore you end up with lesser hourly rates or lesser project costs. But when it comes to niche companies, they're developing new segments. They could be centric around retail, they could be centric around aviation, tourism and other forms. And some of these companies had decent cash flows, but were completely surrounded by the negative taboo around the IT stock valuation and US visa issues and global concerns, etc. But what their annual reports seemed to suggest, and management commentaries were suggesting, was that they were scaling up the R&D expense, to a certain extent, and they were sort of bettering their financials. But the market was not willing to value them over a 10p or a 9p, while they were moving up the value chain. So some of these IT niche stories actually got re-rated in the last 1 year, and continue to report in robust numbers that seem to suggest that the thought process of disruption in new segments is more attuned to them than a larger player who may be doing a substantial part of his business as routine, and not really into too much of artificial intelligence and other things, or of that kind.